Howdy, Jacob here. Today we're looking at creative realities, in the media industry, 43 million market cap, 52 million enterprise value. They provide digital marketing technology and solutions in the US and internationally. They sell solutions to automotive, retail, digital, out of home, comprising advertising networks. So they're more so in the advertising business, headquartered out of Kentucky. Their revenue growth is up a lot from 2014, 13 million in 2014 to 45 million in revenue in 2023, but it's pretty cyclical, it looks like. COVID was a big decrease, and then 2015, almost 15% revenue growth decline. Outside of that, they've been growing very heavily. They're still very small. Looks like their market ownership would be very small in relation to some of those larger advertising businesses or larger digital marketing businesses. So that not necessarily have a moat possibly, but if this is a business that you can really get into, you really understand, you could, if they're able to grow at the historical rate that they've done of well over 10% with some decent margins, I mean, this could definitely be interesting here. So let's look further into it. Income statement shows a little bit of money spent on R&D, maybe about maybe about 2 to 3%. Um, Outside of that, big cost is cost of goods sold, and then sales, general, and admin. Not really many other costs. Huge increase of shares. You see that. Balance sheet has 3 million cash-like products, cash on hand, with a lot of goodwill, a lot of intangible assets. So they don't really have those hard assets, but being a digital marketing company, that's not a huge surprise. They do have 10 million long-term debt, 4 million short-term debt. So that 10 million long-term debt in relation to their free cash flow, at least the most recent 2 years, is not a terribly huge amount. So I wouldn't be very concerned about that. They haven't made a whole lot of money in the past, so we're definitely going to be creating a story here and thinking about how they're going to make money going into the future. Obviously, it looks like the last year in rolling 12, they've made some money, but to fund some of the acquisitions that they've wanted to do, they've both issued shares and issued debt to fund those projects. And obviously, for me personally, I would love for them to do that out of their available free cash flow. But again, if you're not making any free cash flow, I understand if you're a growing business, it's going to take time. You're reinvesting back into yourself. It's going to take, like I said, some time to really get some positive free cash flow. But I would think that they're hopefully pretty close. And again, let's make some assumptions. So because it's more of a story, probably going to be looking at 17.5% return. I want larger return for greater unknowns, right? And so for revenue growth, I think 8% seems reasonable to me. I think the marketing industry itself is going to have high growth, and they're very small. So if they're really good at selling their services, then it's going to be pretty easy to grow at that type of rate for a company this small. For margins, again, we don't see a whole lot of margins here, but maybe let's assume 4 and 6%, given that a lot of their cost is sales, general, admin, cost of goods sold. You can't really get rid of those, especially if you're looking to grow as much as they are likely trying to grow in the future. And so I think those margins are pretty reasonable to me, with share change of, they have issued some shares. They do have stock-based compensation. Let's assume maybe 2 to 3 million shares, which is going to be, 4 million would be about 10% of their business as of current. So a lot of issuance of shares is going to hinder their growth ability, or at least the valuation of their stock. It's not going to limit their growth, but it's going to limit their valuation, especially in my eyes, where I take share change directly into account here. And for a terminal PE, I would say a little bit above market, but again, small. There's not a big moat. It can likely get taken away just as quick as it's growing. And so I want to show how important the share change is. So we're 74% off from the current price that would look attractive to me. And if there were no share issuance, we'd just be having the company stock price would just need to fall in half. And so taking into consideration how the company is going to fund some of those things until it actually gets to make some money is absolutely an important part of the estimation and projection price of the stock today and company today. So for me, based on this analysis, it's going to need to fall quite a bit before you get the return I'm looking for here. I think you got a lot of growth for such a small company. I think if you really understand this business and don't think they're going to dilute their shareholders very much, this could be a company that has a very immense return. But for me, I only like to do further research on companies that look obviously cheap and something that would very likely be a fantastic opportunity and great return. And based on my initial assumptions from the financial statements and from what I'm seeing on those, it's not looking like it's obviously cheap. I hope you enjoy.